Market downturns can be scary. The news is full of pessimism. Investors are selling their stocks. It feels like the world is ending. But experienced investors know that downturns are opportunities. Just like a storm clears the air, a downturn clears out the excesses of the market. This is the time when savvy investors can find great deals. Think of it like a sale at your favorite store. The prices are slashed, and you can finally afford that item you've been eyeing. The same logic applies to the stock market. When prices are down, you can buy more shares of great companies for less money. This is the time to be greedy when others are fearful. Of course, investing during a downturn is not for the faint of heart. It requires research, patience, and a strong stomach. But if you're willing to put in the work, you can reap the rewards. This essay will guide you through the strategies that work, using examples from the Nifty 50. Let's turn this downturn into an opportunity. Before we dive into strategies, let's define what a market downturn is. Generally, a downturn, also known as a bear market, is characterized by a 20% drop in the market from its peak. This decline is usually accompanied by negative investor sentiment and economic slowdown. But remember, not all downturns are created equal. Some are short-lived, while others can last for years. The key is to understand the underlying causes of the downturn and assess its potential duration. For instance, the 2020 downturn triggered by the COVID-19 pandemic was swift and sharp. In contrast, the 2008 financial crisis led to a prolonged period of economic uncertainty. Recognizing these differences is crucial for making informed investment decisions. By understanding the nature of the downturn, we can better position ourselves to capitalize on the opportunities it presents. One of the most effective strategies during a downturn is value investing. This approach focuses on identifying companies with strong fundamentals that are undervalued by the market. Think of it like finding a hidden gem in a dusty antique shop. The gem might be covered in grime, but with a little polishing, it can shine brightly. Let's take Reliance Industries, a heavyweight in the Nifty 50, as an example. During a downturn, the company's stock price might drop along with the broader market. However, its underlying business, with its diverse portfolio spanning oil and gas, telecom and retail, might remain strong. By analyzing Reliance Industries' financials, market position, and future prospects, a value investor can determine if the downturn presents an attractive entry point. Remember, value investing is about looking beyond the short-term noise and focusing on the long-term potential of a company. While fundamental analysis delves into a company's intrinsic value, technical analysis focuses on chart patterns, trading volumes, and other market indicators. It's like reading the tea leaves of the market, looking for clues about future price movements. Let's consider Infosys, another Nifty 50 giant, as an example. Technical analysts might study Infosys' stock chart for patterns like head and shoulders or double bottoms, which could signal a potential reversal in its downtrend. They might also look at trading volume as a confirmation tool. For instance, a high-volume surge on an upward price move could suggest strong buying interest and a potential trend reversal. Technical analysis can be a powerful tool for timing your investments during a downturn. It can help you identify potential buying opportunities when the market sentiment is shifting from pessimistic to optimistic. Section 5. The power of not putting all your eggs in one basket. You've probably heard the saying, don't put all your eggs in one basket. In investing, this is called diversification. It's about spreading your risk by investing in a variety of assets. Imagine you invest all your money in a single stock, and that company faces unexpected challenges. Your entire investment could be wiped out. But if you diversify your portfolio across different sectors, asset classes, and geographies, you reduce the impact of any single investment on your overall portfolio. For example, a well-diversified portfolio might include a mix of large-cap stocks like Reliance Industries, mid-cap stocks, bonds, gold, and even international equities. This way, even if one asset class is performing poorly, others might cushion the fall. Section 6. Mastering market timing with dollar cost averaging. Timing the market perfectly is notoriously difficult, even for seasoned professionals. Dollar cost averaging offers a disciplined approach to investing that eliminates the need to predict market movements. This strategy involves investing a fixed amount of money at regular intervals, regardless of the market's ups and downs. When the market is down, your fixed amount buys you more units, and when the market is up, you buy fewer units. Think of it like filling your car with petrol every week, regardless of the price. Some weeks you'll pay more, some weeks you'll pay less, but over time, you'll likely pay an average price. Dollar cost averaging takes the emotion out of investing and ensures that you're buying more units when the prices are low, potentially maximizing your returns over the long term. Section 7. HDFC Bank. A real-time downturn play. Let's look at a real-time example from the Nifty 50. HDFC Bank, a leading private sector bank, often experiences price fluctuations during market downturns. However, its strong fundamentals, including its vast branch network, robust loan book, and focus on technology, make it a compelling investment proposition for long-term investors. During a downturn, HDFC Bank's stock price might drop, presenting an opportunity for investors to buy into a quality franchise at a discounted price. Investors can use a combination of fundamental analysis, technical analysis, and dollar cost averaging to take advantage of such opportunities. Remember, investing in a downturn is not about predicting the bottom. It's about identifying companies with solid fundamentals that are likely to weather the storm and emerge stronger. Section 8. The psychology of investing during a slump. Investing during a downturn is as much about managing your emotions as it is about making smart financial decisions. It's natural to feel fear and uncertainty when the market is plummeting. The key is to avoid making impulsive decisions based on these emotions. One common mistake investors make during a downturn is panic selling. When the market falls sharply, it's tempting to sell everything and cut your losses. However, this often leads to selling low and buying high, which is the opposite of what you want to do. Instead of reacting emotionally, try to approach the situation with a calm and rational mindset. Remember that market downturns are a natural part of the economic cycle. What goes down must come up. Section 9. The long game. Why patience is your best asset. Investing during a downturn requires patience. It's not a get-rich-quick scheme. It's about planting seeds that will grow into fruitful trees over time. Think of it like planting a mango tree. You wouldn't expect to harvest mangoes the next day, would you? It takes time, care, and patience for the tree to grow and bear fruit. Similarly, when you invest during a downturn, you're essentially planting seeds for future growth. The market might not recover overnight, and it might even test your patience with further dips. But by staying focused on the long term, tuning out the noise, and sticking to your investment plan, you increase your chances of reaping the rewards when the market eventually rebounds. Section 10. Weathering the storm and reaping the rewards. Market downturns are an inevitable part of the investment journey. They can be intimidating, but they also present unique opportunities for those who are prepared. By understanding the dynamics of market cycles, employing sound investment strategies, and managing your emotions effectively, you can navigate downturns successfully and potentially emerge stronger. Remember to focus on identifying undervalued companies, diversifying your portfolio, and employing dollar cost averaging. Most importantly, stay patient and keep your eyes on the long-term prize. As the legendary investor Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." By embracing this contrarian approach and approaching downturns with a strategic mindset, you can turn market turmoil into profitable opportunities.